All right. Hey, everyone, and welcome to the Dividend Power Hour. If this is your first time joining, my name is Mark Rushin. I'm a CPA, but not a financial advisor. I put out videos on a weekly basis on Mondays and Wednesdays, covering all certain areas of the market, dividend stocks and ETFs primarily. And we've started doing this Dividend Power Hour as a opportunity to just interact with you guys and answer any questions that you have, and also just do an economic update. What's going on in the market that you should know before you make your investment decisions moving forward. So it's great to be with you guys again. I hope everyone's doing well. In the comment section, let me know where you guys are listening live from right now. I'm here in Southern California. It continues to be very gloomy here, so we're still waiting for the sun to peek out and move on to summer, even though it's summer break for the kids. So in the comment section, let me know where you guys are tuning in from, and I hope your week is going well so far. So I already saw the brown guy in there. Great to have you yet again. It's always great interacting and seeing familiar faces as well as seeing new faces as well. James, great to have you tuning in today. Suburbans of Boston here for Mike. So I'm assuming the workday is probably at the end of a stage there. It's dinner time, so I'm over here on the West Coast. So we're still plowing along. Total Returns is from Detroit, Michigan. Awesome. Great to have you tuning in. Armando, good to see you again. Hello to you and everyone else in there. So East Lansing, awesome. Kevin, I have my brother actually was living out there for a couple years, working before he moved back to Southern California just to be closer with family. But he was out there for quite a while. So we got Bob Tagg from suburbs of Chicago. Mike from, I'm sure it's sunny over there, sunny Daytona Beach, much sunnier there than it is here in Southern California. Amsterdam, awesome. Great to have you, Jeff, tuning in from Amsterdam. Armando, I think we saw that last time. Dallas, Texas, awesome. James is from Las Vegas. We have some folks from West Midlands, UK, but we'll be going to sleep very soon. Yeah, I was going to say it is quite late there. It's probably, is it midnight right there? I believe is if my time calculation for Midlands is correct. So Matthew, great to see you. Bay City, Michigan, another Michigan there, and Toronto. So we got Canada, the UK, we got the East Coast here in the US, the Midwest, as well as the West Coast. So let's jump into the slides that we got going here for you guys. I have an exciting, there's been a lot going on in the market. So let's kind of start diving into it as we go through our slides. So let me throw those back up on the screen here. So again, this is the Dividend Power Hour. And as you guys have questions, just throw those in the comment section and I will get to as many as I can. We've had a ton coming in the last, we've had over 100 people that have been joining the live stream at one particular time in terms of peak. So we do get a lot of questions, but I try to get to as many of those as I possibly can during this time together. So this is what we always start with, our economic outlook. What's going on in the stock market in the weeks ahead, as well as the current week. So we've entered this, and you've probably seen a lot of talk of it. Are we in a new bull market? Well, if you go by the definition, a bull market is usually 20% off of your lows. So the October lows is the 52-week low for the S&P 500. From that point on to today's close, we are 26% off of those October lows. So that's over 20%, which meets the definition of a new bull market. However, economists are still divided as earnings may still lag, and that could really stall a lot of those gains that we have seen there. So we're going to look at valuation here in a second, but it's just really this bull market. It's very one-sided, and there's too few stocks, participating in this. When you have, the top 10 that accumulates roughly 90% of the total gains within the S&P 500 this year, that kind of gives you pause, and there's a lot to be excited. A lot of people have made a lot of money thus far, but there's also, we're never going to be able to time the market. I'm not in this game to time the market, just trying to educate and be mindful of the data that's coming out. So in terms of valuation, we look at this each and every week. EPS is still at $220. I believe that's going to start adjusting here once we get through the Q2 earnings, which will be coming out after June 30th. So a couple weeks after that, we will dive right back into earnings season and really see how these companies truly are doing. So at 220 on the year for 2023, the S&P still trades at 20.1 times. We continue to go higher. 2 weeks ago when we did the live stream, we were at like 18.5. Then last week we were at 19.5. Now we have surpassed 20 times, gaining another 3% in terms of that multiple. Again, the averages tends to be around that 15 to 17 range. It's trending a little bit higher as of late, just because we have a lot of growth stocks that are within the S&P 500. In terms of employment, throw this over here. Ooh. In terms of employment, jobless claims were flat week over week, about 262,000. So if you look back at last week's live stream, it was about 261,000 people filed for unemployment that week. They usually go through and do one more check. It came in and they adjusted that 1,000 folks higher. So 262,000 remained flat, but it's still the highest levels that we have seen since October of 2021. And then there's a 4-week average. So similar to how you look at simple moving averages, the 4-week average increased 9,000 to a total of 246,750 people on that 4-week average unemployment claim. So that's continuing to trend higher. Housing, so for the first time in more than a decade, homeowners actually experience a decline in home equity. And then rates continue to be high, inventory low. So it is an interesting, I should say, housing market. But if you look at the home builders, that wouldn't tell you that it's that much of a struggle, because the home builders, a cyclical business, have been doing quite well. The Federal Reserve, as you may know, hit pause on rate hikes this month. So we stopped hiking for, it was over 10 consecutive meetings that we saw rate hikes. That has finally paused. It is more of a skip, as many economists believe that rate hikes will resume here in the July meeting. So something to note, though, was that the Fed Chair Jerome Powell did signal 2 additional hikes to come the remainder of this year. So that was kind of an interesting to note, is because a lot of economists were, they were saying, well, we're either going to have a pause now and then a hike in July, or let's just hike now and then begin the pause, a more long dated pause. There wasn't too many people that were out there saying, oh no, we're gonna have 2 more hikes. We're gonna pause and then have 2 more hikes, or we're gonna do a hike now, pause, and then another hike. There wasn't many in that camp that was looking for 2 hikes. So I think that came as a little bit of a surprise. But as we've seen in the stock market, investors are really pushing the Fed to the side and saying, no, we're going to continue plowing forward, primarily in the top 10 stocks within the S&P 500. So something very interesting there. In terms of inflation, since the last time we met, the CPI report came out for the month of May. Month over month, it was up 0.1%, so pretty much flat month over month. But year over year, we're still at 4% growth in terms of CPI. However, core CPI, which takes out the volatile energy as well as food, that was up 0.4% month over month and 5.3% year over year. So that number was a little bit higher than I was looking for. In terms of estimates, they were pretty much online where a lot of economists were looking for in terms of CPI. One of the big, proponents of that was the energy slid. That whole sector slid 3.6% in May, which really kept down the total inflation amount. Because if energy hadn't struggled in the month of May, we would have saw a much higher just regular CPI number. So because of that, we did get a little bit of a break, but the proof is in the pudding as well. Something to be mindful of there moving forward. So let me check on the comments here, make sure I'm not missing anything. So we got folks tuning in from Florida, Ventura, California, Charleston, South Carolina for William, St. Louis, awesome, for the Punisher, Journeyman Portfolio, Columbus, Ohio, tuning in, and another back-to-back Ohio here. So that is awesome. Thank you. I do this for you guys to try and educate as much as I can and just be able to help investors be their own portfolio managers. So that's really the idea behind the channel, really focused on dividend stocks, ETFs, and just building a portfolio the safe way. Again, I say it every single week. It doesn't say that I only invest in dividend stocks. I have a lot of growth stocks within my overall portfolio, but I would say the majority of my portfolio is ETFs and dividend stocks. So something to be mindful of there. So let's get back here to the slides and let's see what we're gonna discuss here. So are we in the start of a new bull market? Again, we looked at it. We're 26% off of the lows. So I would love to hear in the comment section, do you guys believe that this is truly the start of a new bull market? Are we going to be, just plowing forward here? The lows are in. We're never going to retest those lows. We're never going to go below those lows here in the near future. I'm never going to say never because anything is possible. But do you believe that we are in the start of a new bull market? So economists, they continue to be very divided. You have major firms like Goldman Sachs, who is very bullish. They hiked their year-end target for the S&P 500 by 10%. Part of this, though, is to catch up. So I'll show you some of those S&P 500 targets what they were at the start of this year and what they are today. So some of that is just catching up with how far the market has run and adding on a little bit to the top there. So, but then there's an interesting one from Wells Fargo. So they had I believe it's 4,400, and I can just jump forward here to the next slide here. You have Wells Fargo sitting there. They had a $4,400 price target for the S&P 500. Right now, that's pretty much where we're sitting. But the interesting thing is they didn't really piggyback and say, oh, well, we hit our target. We're just going to be flat for the rest of the year. No, they went out and said, no, we're actually going to cut our target. They cut their target from 4,400. And as of today, they've cut it down to 4,100. So they believe there's about a 10% correction within the market that will go back down to test that 4,000, 4,100 level. So that was an interesting thing when I was kind of doing my research here for this live show here today. So we touched on Goldman Sachs being very bullish. We talked on Wells Fargo being very bearish. Something else to note during the research I was looking at was the bear markets of 2000 and 2008 saw multiple rallies very similar to this that were in excess of 20%. You could have saw this jump of 20%, said, boom, we're in a new bull market. However, they saw in 2000, 2008 multiple times the market end up falling back down, proving that we were still, in fact, in a bear market. So that did not necessarily constitute the end of those bear markets in 2000 and 2008. So something else to touch on, valuations are still quite high, and inflation levels, although they are getting better, are still quite high based on historical averages. Interest rates continue to remain elevated. And if we do see a prolonged pause, a lot of folks are saying, okay, that was our hike. That's most likely our last hike. I know the Fed said we're going to do 2 more, but that's most likely our final hike that we're going to see. However, it is very split. But I think there's a consensus that we're not going to get rate cuts. There's a lot of economists that were talking about us getting rate cuts by the end of this year. I never thought that. You can go back to many of my lives, many of my YouTube videos that I've put out. I've never been in the camp that believes that we are going to see rate cuts. If we do see rate cuts, there's a lot more to be concerned about because rate cuts usually coincide with a poor economy. Inflation's really high, which it is high. Unemployment, though, skyrockets, and the Fed needs to give a break and provide a little bit of stimulus back into the economy to get things going again. That's not really the case right now. We still have a very heated economy. Employment is still is historically low, pretty much at full unemployment. So, they're trying to. There's a tricky road for them to try and emulate and do this soft landing, as folks call it, to where you're able to increase interest rates to combat inflation without seeing a skyrocket, a big jump in unemployment. They don't necessarily want people to lose their job, but they understand that that's the true way to really fight this inflation that is very sticky and not coming down as fast as they had hoped. So we have valuations high, we have interest rates that are remaining elevated and will continue to be so for a prolonged period of time. I think this is kind of that area that we're going to start seeing for the near term and the foreseeable future. But another thing to note is we are seeing wealthy investors. This is people with portfolios of $1 million, 5 million plus that are raising cash. They're actually selling stocks, and the stock market is still climbing higher. So wealthy investments are raising cash at a rate that has not been seen in years. So that's something to be mindful of. So, institutional investors are still obviously investing there, but we're seeing these individual wealthy investors that are starting to raise large amounts of cash. Now, why is this, you might ask? Well, we have we have very high valuations, as we've touched on, with the S&P 500 trading at around 20 times 2023 earnings. But the other thing is there's some unique opportunities for investors. Usually when you have a portfolio of $1 million, 5 million plus, you're probably, you're probably not 20 years old with a long time horizon. You're probably maybe 40, 50, 60, somewhere closer to retirement, where you could say, oh, there's a high yield savings account where I can get 5 or 6%, or other fixed income positions where I can get 6, 7, 8% right there without taking really any risk at all. So why should I put my money in the stock market? That's another reason why we're seeing a lot of capital being raised here so far from these wealthy investors. So looking over here at this chart, you can see here, this is, from FactSet, this is the S&P 500 earnings growth based on the quarter. So Q1, we saw negative 2% earnings growth. But Q2 is expected to be, that's supposed to be our trough there. That's supposed to be over minus 6%, about 6.5% decline in EPS for the S&P 500. And then after that is when we're going to start moving up. So that's kind of some of the reasons why you're seeing the stock market move higher, is because the S&P 500, it doesn't necessarily trade on what's happening in the economy today. It's a forward-looking tool. So you have a lot of investors that are looking and say, hey, I can invest now, and by Q4, we're going to have 8% EPS growth. That is some stunning EPS growth. I'm not worried. I know Q2 is going to be bad, but part of you, though, as an investor says, well, the earnings we've seen them come down, but they're continuing to accelerate lower. So at some point, high valuation has to come into play. And at 20 times 2023 earnings for the S&P 500, that's not somewhere where I'm looking to throw tons amount of money. If you are a subscriber to my Dividend Investor's Edge and you look at my monthly portfolio, you could see the amount of cash. I show in there where my cash position is, and right now it's a top 5 position in my portfolio. I try to continue to look for opportunities and value. You bought a little bit of United Health in the fall yesterday, bought a little bit of CVS recently. So if you want to see my dividend portfolio, get those monthly portfolio updates where I show all the dividend income I'm receiving. I also show all the buys and sells, as well as a quick, watch list, a top 3 stocks that is on my watch list for the following month. Then you can sign up, go to russinfinancial.substack.com, or you can just go to russinfinancial.com and you'll see a little button there for my newsletter. I have a free version as well as a premium version. If you want to see the portfolio, that's the premium version that you can add for less than $1 a day. So, we have a great growing community over there of roughly 10,000 subscribers. So definitely come and check that out and become a member today. So what questions do you guys have for me before we keep, moving forward here? Let me kind of catch up on a lot of those. So Mr. Snazzy, is SoFi running away too fast? SoFi has had a, quite a day. Let me add this to the stream here so that you guys can see my screen here, so I can kind of show you. If you guys don't follow SoFi, obviously it's not a dividend stock, so we don't talk about it a ton here, but you can see the move that just in this month period alone, that the stock was below $5, and now they were up near $10 recently. So that is essentially doubling. Year to date, the stock is up 112%. So they have doubled this year alone. I'm just talking about in the past month alone. You can see they have 113% in the last month. There's still a lot of folks that are high on SoFi. So it's not one that I've looked into a ton lately. But I'm typically not going crazy for a stock that just increased over 100% in a month's period of time. So it's probably a little bit more of my conservative investing style there. So not one I'm running after. I wish I was in it before that. Probably a month ago would be a great timing, or in some option contracts, but unfortunately was not there. But I know a lot of folks that were happy about it and still underwater. But that's been great there for those that are in SoFi. What else you guys got for me right now? Gretch is waving. Hello, Gretch. Great to have you again. The market is indeed quite bifurcated right now. It's really top heavy, and we have a slide that we'll see here later on as we continue to go through that, showing you how one-sided the stock market is right now. Investor's Edge. I like that name. I think financial stocks and companies with high debt will struggle for a while longer, especially companies that have variable debt. We're in this high rate environment. We've gone through a decade with essentially 0% interest rates for the most part. There's actually still some, I saw someone that in my neighborhood that actually bought a golf cart. You can, buy, or there's areas to drive these NEVs, neighborhood electric vehicles, and they still had 0% for that. So there are still some 0% opportunities out there, but not as much anymore. But a lot of these companies that need to get variable debt, REITs rely a lot on debt because just the formation, how they're created. They have to give 90% of their taxable income back to shareholders in the form of dividends. So they rely a lot on debt to continue to grow their portfolio. But that doesn't go on to say that you shouldn't invest in REITs right now, because there's still a lot of high quality REITs. Take Realty Income, for example. They have an A-rated credit rating. They get very favorable debt terms, whereas you have these smaller REITs, something like NetStreet, which I like a lot and compare it to Realty Income. They don't have that same track record. They don't have that same credit rating to be able to get the same favorable terms that someone like Realty Income, if they see a property that they want to add that will be accretive to their portfolio moving forward, you'll see much different interest rates between someone like Realty Income and NetStreet, who's the lower kid, the smaller REIT on the block. So that's kind of been the talk of the tape here that Slim is touching on. Is there's been a lot of talk on a lot of these refinancing deals that are coming to fruition here in the commercial real estate business. We have student loans that he's mentioning here that it's coming back on. This will all impact inflation numbers. We talked about on the live last week where consumers have had a lot of extra money, right? They haven't had to pay their student loans in about 3 years now. Those are coming due, and those are sizable amounts. I think we looked at the average was around $500 a month across all of them. It's going to suck out $16 billion, and this will undoubtedly have a impact on consumer discretionary spending moving forward now that those payments are coming due. So great point there from Slim. What other questions do you guys have here? Seems like it's getting stable now. Hope it keeps going up. Well, we always want the market to keep going up. But part of me, being a long-term investor, is you want those corrections. You want those opportunities to get into stocks that have high valuations. Obviously, I would love to add. I have Microsoft and Apple in my portfolio. I would love to add more. I'm not going to add them at 30 plus times earnings right now. It's just not something, the key to in these high rate environments, the key to these high valuation points is you don't want to chase stocks. Stick to your strategy. Don't invest in things that you don't pay attention to. If you're not someone, we're looking at SoFi on the screen here right now. If you're not someone that's familiar with SoFi, you could look at a stock that's been up over 100% and say, man, I got to get me a piece of that. Who doesn't say that stock doesn't go down 40% in the next week and the rest of the year? You don't know that. Because if you don't follow SoFi, stick to your strategy and don't get the urge to jump somewhere that doesn't stick to your strategy. So that's a big key when it comes to investing, especially in the stock market where it's continued to climb higher. Look at Tesla. We just saw 13 consecutive green days. Who doesn't want to? I bet there's a ton of people out there that jumped in yesterday and boom, all of a sudden that was snapped and they're saying, well, here's my luck. So if you don't follow Tesla, don't just jump in because you saw it increasing for 13 consecutive days. Don't be a YOLO investor. That has got a lot of people. It's made a lot of money for some people, but it's also lost a ton of money for a lot of people. So just be mindful of that. Stick to your game plan. Make sure you create and build out a strategy and stick to your guns. James says, because of the rate hike pause, would now be a good time to look at bank stocks or stay away? Looking at the consumer stocks, the regional banks, I should say, not the consumer stocks, it seems like things are starting to stabilize and that threat has kind of been set aside. I'm not going to say it's gone, but I'm going to say it's been set aside. I think there's some great opportunities in regional banks, mid-sized banks, as well as large banks. I mean, you're getting Bank of America at about 8 times earnings. I did a video recently on JP Morgan. You're sitting at 9 times earnings. I mean, you're talking about the largest bank here in the US. They have 1.7 trillion in assets. Their deposit levels, are fine. Great leadership from both of them. I own Bank of America. I don't own JP Morgan right now, but both of them are even, very reasonable valuations. You have a US bank, which used to be a Buffett favorite, that is trading at great reasonable valuations as well. So it's definitely, if you're a value investor, you have a long-term horizon, you're not worried about the near term, but you do know that you're getting in at a great valuation. I think that's the key. That's a good area to look if you're looking for some financial exposure. Investor Edge believes that there'll probably be 1 or 2 more hikes if we can believe the Fed, which I think that's done a lot of investors some good lately. As they've continued to tell us we're continuing to hike, but there's been those economists out there say, no, we're getting rate cuts at the end of the year. And I haven't heard them say once. I haven't heard one Fed officials say we're going to rate cuts. Jerome Powell, the chairman, yesterday said rate cuts aren't out, not just the end of this year. They're not even out for a few more years, plural. So he doesn't believe we'll get rate cuts or even be discussing rate cuts until at least 2025. So something to be mindful of. I think we at least get one more hike. I was surprised on the 2-hike call, but I think we will get at least one more hike. Christopher had a question. What is $1 a day? Signing up for the Dividend Investors Edge. So you can see the link down there at the bottom of the screen. So you should see it right there. You can see the how to get to the dividendinvestorsedge.com. I have a free version, which I put out a weekly kind of economic update, touch on about 5 different economic topics. And then, but the premium version will get you access to my dividend portfolio. I also add in stock deep dive. So you'll get a research report about 5 to 7 pages, very easy to read, tells you about the company, tells you about the past 5+ years of revenue growth, free cash flow, looking at EBITDA, various metrics that we're looking at in terms of valuation, looking at analyst price targets, fair value, and just a bunch of information to help you make more well-informed decisions. So we look at 2 dividend stocks each and every month. And we're going to try to continue to update not only the reports that we've done in the past, but also look at new companies moving forward. So we have a team that we're continuing. I've really done those on my own since the start of the Dividend Investors Edge, but looking for more analysts to add to the team who can start helping me write more of those. And hopefully I can get out maybe 3 of those per month and just add more value for premium subscribers. We also have a valuation dashboard that we put out in the middle of the month, which kind of just shows you different stocks within our coverage area and their valuation based on a discounted cash flow. So you can add that for just $1 a day. You can sign up to be a premium subscriber. Very simple. All right, what else we got here in the questions? Snazzy is asking about Moderna. So in this sector, I've been focused on Pfizer. I have a lot of healthcare. So I don't own Moderna. I have a lot of healthcare exposure when you look at Johnson & Johnson, AbbVie, Bristol Myers. I like Merck. Don't own Merck yet. Been looking for a better entry point. So a lot of exposure to not only healthcare but pharmaceuticals. So Moderna isn't one that I'm looking at necessarily right now. I've been more focused on Pfizer and Merck have been at the top. I try not to have a ton, too much exposure to one particular sector there. So that's just my thoughts on Moderna. Doesn't take anything away from it at all. Investors Edge was about to buy a share of UNH earlier. Thanks for confirmation. Yeah, so yesterday on the big drop down, UNH is the largest holding within or the largest weighting within the Dow Jones Industrial. So that's a price weighted index for those of you that are not aware. It has over a $400 share price. So that means the highest share prices have the largest weightings, whereas the S&P 500 is a market cap weighted index. More focused on the market cap value of a particular company instead of the share price. Doesn't really matter in the S&P 500 like it matters in the Dow Jones Industrial. However, they are a very large conglomerate within the health benefits sector. Always been a great company, pay a low dividend yield, but they have strong dividend growth, about a 5-year dividend growth rate, average growth rate of 17%. They recently gave us a 13% dividend hike, which I was able to get in before that ex-dividend date. So I'll get that dividend here in about a week or so. So it's just been a company that's been high on my watch list. And this was just an opportunity to jump in. Didn't, go full boat, but, started a position, but then also sold cash secured puts at a lower price. So if it continued to fall, I would be able to add at a much lower price, which is one reason. That's usually how I enter into a lot of my new positions. So that's what I did for UNH. The stock was up a lot today. So, I pretty much collected, almost 100% of the premium. I think I'm about 90% gain on my cash secured put that I sold. So I'll probably close that out there tomorrow and look to see if we could sell another one here in the near future. Shane has a question. Mark, do you think student loan payments restarting this fall will help slow the economy down too? Yes. So I just, mentioned that a few moments ago. This is going to suck out about $16 billion worth of consumer discretionary. So it's definitely going to have an impact. And I think it's going to have an impact particularly on those consumer discretionary type items. The thing with the U.S. consumer is they've been really focused on luxury and travel. That's been huge areas of economic boom, really. We've seen, the likes of Target and Dollar General. Target's got a whole other slew of issues, but they've also have earnings issues as well. but they're really struggling looking for consumer dollars. Dollar General, even they're a dollar store and struggling. But then you have the likes of Delta, seeing a lot of folks increase this various different perks and flying all over. They actually increased Delta, American Airlines, United, all increasing their earnings guidance for the rest of the year. So they're upbeat on that. So that's an interesting one to look. We just got a report on casinos. I mean, that's got to be the ultimate discretionary. If we're in a recession and you're struggling, the first place if I'm living paycheck to paycheck, the first place I'm running to isn't the casino. They just saw record April revenue there for the casinos. So that's I'm long Vici. That's not the casino operator, but that just kind of tells me and strengthens the Vici operators there. So VICI is the largest landlord on the Las Vegas Strip. So one to be mindful of. Excuse me there. If you're looking for a REIT in that sector. What else? I'm trying to catch up here as fast as I can, guys. So what are your thoughts on US Bank Corp from the Brown guy? I touched on US Bank Corp. If you're looking for, a financial sector, more of a mid-size regional bank, then, US Bank is probably the best of breed in that one. Is now a good time to jump into O. Let's see where, I've kind of talked about it a lot. And I always like that 5% yield. That's the time when I add to Realty Income. So it's not a stock I've added to a ton recently, but at 5%, that's always been my area, and it's proven. If you look historically, anytime Realty Income's been trading at a 5% dividend yield, it has proven to be a great entry point. Right now, they're almost exactly at 5%. So I think that's a good one. Long term, you got a very small. They don't increase their dividend all that much. They do it consistently. They do it on in every quarter, really. So you'll see very small amounts that add up to still a small amount. They're about a 5-year dividend growth rate of, I want to say 5 or less than that, 4%, not even. So they're one of the stocks I'll show you that did increase their dividend recently, albeit very small, but they do it on a consistent basis, given that they are a dividend aristocrat for increasing their dividend for 25 consecutive years. So let me keep rolling here with the slides. I see a lot of questions. I'm trying to get to those, but let's keep getting to the information here at hand. So I promised that I would show you these S&P 500 targets that I drum up here. So what this is showing you is all the different Wall Street firms that you could see on the left side. So you have the likes of Goldman Sachs, you have Oppenheimer, Bank of America, Wells Fargo, Jefferies, JP Morgan, Citigroup, Morgan Stanley, UBS, all those major Wall Street firms on the left side. And the next column is going to show you what was their 2023 S&P 500 targets for the end of the year. And these targets were made at the end of 2022. So at the beginning here of 2023. By the end of the year, where do you think we're going to be? Well, when you're going down all of these, the average is 4,036. And excuse me, but as of the close today, the S&P 500 closed at 4,420. Far exceeding the average and far exceeding every single target on here except for Deutsche Bank. They had a target of 4,500, so they were the most bullish, and they're actually the closest so far. So what the last column is, though, is okay. Now that we've seen this run up, the stock market has gone up to 4,420. So as of as of June 13th, I should say. Let's update those targets. And let's see where we're going to finish. Where do you think the S&P 500 is going to finish now? So you'll see the green plus signs. Those are firms that increased their price targets. If there's nothing next to that new number, then that means they just stayed stagnant. And if there's a minus sign, then you could probably guess that the target came down. So Goldman Sachs, as I mentioned, they were the biggest adjustment. They went from 4,000 price target up to 4,500. Again, a lot of that was to adjust to where we're at right now. So 4,420, and then add a little bit on top. So they think we're going to gain roughly 80 points, only really much of 2% for the remainder of the year from here. So, not a ton of bullishness when you look at the entirety of all of these price targets. This is all telling you that pretty much every single firm expects the S&P 500 to pull back from here. I think that's a message that I'm kind of that's my thought process for the remainder of the year, or at least at some point we're going to see a big correction, which is going to be just an opportunity for long-term investors. So you can see Wells Fargo is the only firm in this entire list that actually cut their price target from what they put out at the beginning of the year. And then you have 6 of these firms that actually increased their target where everyone else kind of stayed the same. Now on the average, we went from 4,036 up to roughly 4,113. So 4,113 is still a long way away from 4,420. So they're really expecting that, close to a 10% correction. And that's by the end of the year. So could we see some turbulence on the horizon? I believe so. I think there's a lot of folks in that camp that, professionals, not just me. I've been investing for over 15 years, but these folks are, quote unquote professionals, believe that we are in fact going to see some sort of correction here in the near future. So here's a question I have for you guys. Which group of stocks would you rather own the remainder of the year? A, technology; B, low value stocks, which, you're not going to really find many technology companies in low value. So I can create that as its own category. Or dividend growth stocks. That's the likes of, Home Depot, which, can almost be considered a value stock right now with where they're trading, or Lowe's. But these are the 3 options: technology, low value, or dividend growth. Let me know in the comment section which group of stocks, which group of these 3 stocks would you rather own the remainder of the year? Slim says it's always a good time to buy Realty Income. And they did indeed just raise their dividend income, which we will look at a slide of companies. Yep, Cat is on that list too. They increased their dividend by 8% yesterday. So not too shabby there. Not too often do folks get an 8% income raise. I know that the average has been about 3%, which has been the average inflation. But as we've seen over the past 12, 24 months, inflation is much higher than 3%, unfortunately. Gretch likes Bank of Montreal, which has been up a few percent most days recently. All right, let's answer this question here. Mickey, what is better, large growth? I'm going to assume that means dividend stocks with low yields, or decent or low growth with dividend stock with a large yield from 4 to 8%. So I think what you're asking here is would you rather camera. But good question. What else you guys got? Armando is going with low value with his answer. I'm catching up now to my question on, what type of stock, which, let me go back to so I can remind everyone, which group of stocks would you rather own the remainder of the year? Technology, low value, or dividend growth? I know this is, it could be a weird question because you're saying, Mark, you're looking at sector compared to the type of stock, but we're going to do it anyways, because that's what we do on the Dividend Power Hour. So Armando's going Amadou. I'm going to go Amadou. Correct me, though, and apologies if I got it wrong. Low value, sir. Todd is going dividend growth. Justin's going low value. Ryan is going to go C, then A. So he's still sticking with technology, but focusing on dividend growth there. You guys are saying no audio, so let's do this. Test. Can you guys hear me or no? Can someone in the comments check your mic's power? Can you guys hear me now? Hello, hello. I just switched over to the Mac because I do not know what is going on with the microphone's been a little fidgety here my last few videos, so we might have to upgrade that one. So apologies there. So glad you guys can hear me now. So let me go back up to what I was saying here. Kevin was updating us here on the U.S. Open, so thank you for that. -8. Some of you said I was frozen, so here, see, I gotta catch up. But hopefully you guys saw Wes's comment on Kodak. Amadou is looking for low value. Todd is looking for dividend growth. Justin, low value. Ryan is looking for dividend growth and technology. And then here's all the frozen power hour. Power hour lost power. Power hour lost audio power. We are still here and still rolling. All right, what else we got here? Okay, everyone can hear me now. We can hear you now. The audio's back. Now we can't. We can. All good now. Benoit. Dividend growth. I'm always on the dividend growth train. All right, come back to Prologis and American Tower. So what I was saying there is both of these REITs are in my portfolio. Both of these REITs I own. So, I have a lot of love for both of them. American Tower is, both of them are trading at unique valuations. American Tower, as I kind of showed on the screen here, let me pull it back up, is you can see they're in their own recession, down 20% over the past 12 months. So definitely, with 5G continuing to roll out, I was touching on it. I don't know how much was lost in when the audio, the Dividend Power Hour lost power, but I don't know. The thing with American Tower is with 5G rolling out, 5G is night and day compared to speed when you have 4G and 5G. When you're looking at the high bands, the top bands. Now, everyone doesn't use the top bands, but the problem with 5G is it does not travel as far. And with that means a higher need for more cell towers, which is a growth driver for the likes of American Tower. Another growth driver is 3G, 4G. Those things are still rolling out internationally. So, they continue to expand both here in the US and have an international. So it kind of gives you that international exposure. Prologis, on the flip side, gives you that e-commerce. So e-commerce is roughly 15% of retail sales right now. Economists believe that over the next 5 years, e-commerce will eat into that about 1% every year for the next 5 years. So I continue to believe in e-commerce is going to continue to grind higher and become a larger player in retail sales overall, just sitting at only 15 right now. So that's kind of my play with Prologis. Stocks I like both of them for very different reasons. American Tower is very unique in the fact that they are a dividend growth REIT. So, you don't see that all that often just based on the structure of REITs. So that's kind of my take on Prologis. So Victor agrees and has both. Awesome. So let's keep going here. I see more questions, but we're already at almost 50 minutes. We lost some time there with the mic issue, so I apologize for that. So here's some dividend increases over the past week since we met last. We saw Host Hotels, which is a hospitality REIT, increased their dividend by 25%. We had Caterpillar, who increased, as we saw one of the members mentioned, we got an 8% increase in the dividend. Target increased their dividend by 2%, which, that was a little bit lower than, I had expected. They're dealing with some cash flow issues. They're also looking at, what's on the horizon for the economy. So I think it's more of a cash preservation decision there for Target by increasing roughly 2%. WP Carey increased by less than 1%, so not much of a raise there. And then Realty Income gave us 8.2%. Again, they increase on a quarterly basis, so it's it's a sum of the parts, not just one increase, but that is pretty small, and it keeps them in line with their checks the box for their dividend aristocrat status. So now looking back at the economy, looking back at the stock market and this rally, and it's really been a one-sided rally. We've seen this S&P 500 climb, and as I stated earlier, we were 26% higher from the October lows. But it's not all roses for everyone within the S&P 500. When you look at here, the one thing I like to look at is the equal weighted S&P 500, which is up only 5.5% year to date. On the flip side, though, if you look at the regular S&P 500, it is up 16% year to date. So, very different directions there. And it just shows you that everyone is not participating in this rally. So, a lot of the time, strong rallies is when that RSP is right there with the S&P 500. And if you look at a chart, which I've put in some of my videos recently, you'll see over time that RSP, the equal weighted S&P 500, will sit right there. You're going to have these booms in technology, which is when the gap's going to be a little bit. But right now, you can look at market breadth, which is another way. You can look at the equal weight versus the regular S&P, but another way is to look at market breadth, which measures how many stocks are participating in the move higher. This has been this was a unique thing in my research here recently was, I've known that it's been a one-sided rally, but knowing that the market breadth was the weakest it has ever been since they've been tracking this, that gives me some pause on how real is this rally and how many believe that this rally can continue moving forward. So looking at the top 10 positions, which you can see on the right there, that's for the S&P 500. You could see Microsoft and Apple equate to nearly 15% of the entire S&P 500. Followed by Amazon, Nvidia, Google, Tesla. These are all technology companies. And then you have finally Berkshire, Meta Platforms, another technology or communications. And then there's United Health for us coming in at 1.25. So the top 10 positions make up 30% of the entire S&P 500. But when you look at the top 10 positions, they have generated nearly 90% of the index's total return in 2023. That is staggering. Another thing to look at is nearly 350 stocks within the S&P 500 are actually underperforming the index so far. So the S&P 500 is up 16%. There's nearly 350 stocks that are below that so far this year. So another question, our last one here of the day, is which stock in the top 10 of the S&P 500, which we just looked at, and you might already have the question saying, Mark, I only see 9 answers down there. Well, that's because Google has 2 classes of stock, which are both within the S&P 500. If you look over here again, back on this slide, you can see Alphabet A and Alphabet Class C. So we're just going to say Google overall. So which stock in the top 10 of the S&P 500 do you have the most confidence in for the remainder of the year? And yes, Wes, Kodak is not on this list today. So we have Apple, Microsoft, Amazon, Nvidia, which is surged, Google, Tesla, Berkshire, Meta Platforms, another stock that has surged on the AI craze, and then United Health. So from this point forward, which stock do you have the most confidence in for the remainder of the year? Let me know in the comments. Catch up to some of these questions here. I need companies to pay every month. Kings of distribution. So, I recently, hopefully you saw my recent video on this, where I showed how you can have a simple 3-stock portfolio that pays dividend stocks that pay on a quarterly basis but they pay on different months. You have one stock that pays on January, one stock that pays in February, and another stock that pays in March. And then you kind of, the cycle starts over. But that way you're actually receiving a dividend each and every month. So definitely check out my latest video on that. But there's also monthly paying dividend ETFs like JEPI or JEPQ, which I recently did a video on, as well as Realty Income or Stag Industrial are two REITs that pay on a monthly basis as well. So I know a lot of people love their monthly dividends there. Dennis has a question. Will you explain what you mean by dividend growth REIT? What part is growing? So what I mean when I'm talking about dividend growth is I'm not focused as much on the price action when I make that statement as I am on the dividend growth. How fast is the company increasing their dividend? So when your dividend increases, your dividend income is increasing over 10%. I consider this a dividend growth stock. So 10% or faster 5-year average. So when I look over here, let me pull up Seeking Alpha so you can kind of see what I'm looking at. Here's American Tower. If I go to the dividends tab, you can kind of see what their dividend summary is down here. The company has a 3.25% dividend yield. Their annual payout, how much they pay out, moving forward is $6.28 per share. That's on an annual basis and that's really just calculating what's the latest quarterly one multiplied by 4 if they are a quarterly one, multiplied by 12 if they are a monthly paying dividend stock. But American Tower is quarterly, so we're going to take the 157, multiply that by 4, which is they do it for you right here to see how much your annual payout will be moving forward. Payout ratio with REITs, you don't really want to look at with Seeking Alpha. It's not, all that correct how they calculate it, because with REITs, remember, we look at FFO or AFFO, which is adjusted funds from operation. It's more looking at the cash flow of operations rather than EPS, because with real estate, which REITs are, real estate investment trusts, there's a lot of depreciation expense involved in that. So that brings depreciation expense on a GAAP basis, brings down your earnings per share number, which is going to give you a super high payout ratio within the real estate sector. So the way to combat that is by looking at what's called FFO and AFFO. Think of those as the EPS of REITs. But next, what we're going to look at, and what your question was predicated on, was what do you mean by dividend growth? Well, I want to see a 5-year dividend growth rate of above 10%. If it's above 10% on average per year, then that tells me that I consider them a dividend growth stock. For American Tower, it's 16.4%. This means that over the past 5 years, American Tower on average has increased their dividend by 16%, which just puts your compounding dividends. Your dividend income is going to increase by 16%. If you take that and reinvest it back into the company, then you're not taking new money from your bank account per se. You're taking what American Tower paid you and you're just reinvesting it, which adds more shares. So now not only do you have more shares, but the very next year, American Tower, they're increasing the dividend another 16%, which takes your dividend income even higher. So that's kind of that process of the idea of compounding dividends. And then lastly here, when it just says dividend growth, this tells you how many consecutive years has this company increased their dividend. In the case of American Tower, they have increased the dividend for 10 consecutive years and counting. Hopefully that answers your question there, Dennis. Victor, what do you think about having 10 to 12 REITs on a portfolio and about 25 stocks? Too much. Well, the number of positions you hold doesn't tell me the whole story, because your top position could be 80% of your entire portfolio. I want to look more at weighting. For me, my goal is to have the REIT sector is about 20%, 25, usually around 20% of my entire dividend portfolio is dedicated to REITs. I'm a big believer in REITs. It's my way of having rental properties, not having to deal with tenants, property management teams finding the properties. My real estate investing right now is predicated based, solely on REIT investing. So my goal is around 20% REIT exposure. So really just take what's your market value of your 10 to 12 REITs, divide that by your entire portfolio value. That'll give you your total weighting for that sector. And like I said, my goal is about 20% REIT exposure. Gretsch has the most confidence in Tesla moving forward. Now, that is a stock that has been rolling, as we saw 13 consecutive days, and they finally broke that streak barely by 0.35%. You can see over year to date, the stock is up 136% just this year. That is staggering. So, but Gretsch believes it is moving higher. That is one that one's tough. Microsoft and Nvidia for Victor. Again, Nvidia has been another. I mean, both of those companies have crushed it this year, but Nvidia has doubled. UNH, I like that pick, considering that's a value play. If these tech stocks are truly overvalued and we see a technology pullback correction, then UNH could be a sneaky good pick for the remainder of the year there. But Microsoft, Johnny's taking the field here of Microsoft, Apple, and Nvidia. I make sure I catch up here to make sure my sound continues to work. Journeyman portfolio, I would hold dividend growth stocks for the remainder of the year, and for the years beyond that. I am in agreement. Opinions on BSRTF for monthly distributions. I like their valuation. Unfortunately, Dennis, I do not look at that one, so I don't really have an opinion there to make. So, James, are dividend cuts something to worry about if you don't invest in high-risk companies? How often do they occur? Well, I think the key there was not high risk, but I focus on high quality dividend stocks. So being in the market as much as I am, looking at stocks, monitoring them, I look at free cash flows, free cash flow payout ratios, regular payout ratios, just free cash flow in general, revenue generation, looking at the balance sheets. You want to make sure that a company isn't using debt to fund a dividend. That could be a major red flag. You could still have a decent payout ratio, but if a company is utilizing debt to pay a dividend, that is a major red flag there. Something to be mindful of. But as long as you're focusing and doing your due diligence, investing in high quality companies that have strong free cash flows, strong management team, a strong portfolio if they're a REIT product, or strong services or products if they're non-REITs, it's really a sum of the parts. And you should never, if you're doing your proper due diligence, investing in high quality companies like this, I don't think someone should really ever be surprised by a dividend cut. Some of the biggest ones, most notable ones that we've seen was, AT&T recently slashing by 50%. I don't think that came as a surprise. We had extremely high payout ratios. We saw a drop in the quality of the business. We saw, terrible acquisition after terrible acquisition, which they have rid themselves of, thank goodness, right now. And they're focusing back on the roots of what made them a telecom giant. So I think it's really just, if you're going to be a hands-on investor and invest in individual stocks, then there's going to be a lot of work to stay up with that. And I don't see a reason why you should be all that surprised if you are investing in quality companies. Again, if you, like you mentioned, high-risk companies, I would be a little, I guess I would question why we're investing in those type of companies in the first place. Victor says, and that dividend growth needs to be based on financial health. Exactly, what we're just touching on. Investor Edge does not believe Nvidia. He's going to go with, he or she is going to go with UNH, so United Health. Gretch, you don't always need a whole share. Fractional counts also. That's exactly right. Don't focus as much on the number of shares, especially only if your brokerage allows for fractional shares, because not all of them do. But if you're investing $10,000 in a stock, I don't really care if that equates to 10,000 or 5,000 shares or 500 shares. If you're investing in a quality company, you have $10,000 invested, because with both of those examples, if they go up 10%, your $10,000 is going up 10%. It doesn't matter how many shares you have in that case. Where shares really matters if you're doing some stuff like covered calls and playing with options a little bit. That's a little bit more complex. So that's where that kind of comes into play. So let me get back. Seems like I don't see any comments on sound. We're at the hour mark here. So let me kind of get back to the story here and touch on these last few points that we want to make. So now turning our attention to the Federal Reserve. And last week, the consensus was, so that the top chart that you see there with 3 bar graphs, that was what I had in this live last week. And that was for the July meeting. So the next Fed meeting is in July. And it was showing that 35% believe we will have a hike, or we will have a pause, not only in June, but also in July. So we got the pause in June, and 35% believe we will have a pause in July as well. Now, 51% believe we would get one hike. So they're banking on July meeting being the one hike, and the remainder was they believed the 2 hikes. So there was some folks out there that believed we would get 2 hikes. So now fast forward to updated information. Now the July meeting believes we'll have 33% will still be paused. So we paused in June, and they're saying, nope, we're still believing that we're going to pause and we're done with rate hikes. But then 67% believe we will get one more hike. So I thought that was kind of unique how they kind of changed from month over month. So now looking at dividend ETFs, are you when you're investing in ETFs, are you more focused on income related ETFs, which I just did a video on two popular income ETFs, one being JEPI, the other being the younger sibling JEPQ, which has only been around a year but is far outperforming over the past year. Or do you prefer more of the traditional dividend ETFs, broad-based dividend ETFs, or dividend growth ETFs? Or is it a combination of both? With income ETFs, you have JEPI and JEPQ, like I mentioned, where they take a position of holding different securities as well. And they don't have to be necessarily dividend-paying stocks, but then they also utilize those securities to sell covered calls 1 month out. JEPI is more low beta in the stocks that they enter, where JEPQ is more tech heavy. They're NASDAQ related, but they also, JEPI has a broad range within their top 10 positions, whereas JEPQ is very 50% is technology stocks. And then you have QYLD, which also utilizes selling options to generate income. And that's really where the majority of the income comes from for those. That's why they're more called distribution yields rather than dividend yields. Or you have the dividend ETFs. These are more your traditional ones. No options are involved here. It's just strictly passing on the dividends that the underlying positions pay. So SCHD, which is obviously one of my favorites. You're getting a good opportunity to invest in those right now. They're not real tech heavy. So hopefully you have a good tech heavy, something like QQQ or just a higher growth ETF to pair with it. But I just think overall from a dividend standpoint, very well balanced, strong dividend growth. Right now with the tech sector going wild, SCHD is underperforming. And then you have DGRO, which is focused on dividend growth stocks. Same with DGRW, which is one I like a lot right now, as is VIG, which is Vanguard's version of a dividend growth ETF. So definitely, if you are interested in income ETFs, check out my latest video covering both JEPI and JEPQ. So that kind of concludes our dividend power hour for today. Again, I apologize for that soundbite issues that we have where we lost power to our microphone, but we fixed that. So I will take a look and get that figured out for the next week of the Dividend Power. But if you are looking for more information, as I mentioned, you can sign up for my free newsletter, which covers, the top 5 stories related to the stock market, both in the week that we just went through, as well as looking at, some stuff in the week ahead, looking at international markets as well. This is delivered to your inbox every single Monday morning. And then if you want to be a premium subscriber, in addition to receiving the free newsletter, you will get monthly dividend portfolio updates, 2 individual stock deep dives, as well as my investor valuation dashboard. So what questions do you guys have? If you got, I'll take questions for like 2 minutes, and then I have to. We will conclude this because I know I've kept you guys for a while, and I appreciate you guys coming in. A lot of familiar faces, a lot of new faces, which is exciting. Always getting to meet new people, and hopefully you sign up for the Dividend Investors Edge so that you can stay in touch there and join our growing community there as well to talk not just dividend stocks, but also just the stock market in general. So let me know what questions you guys have. I'll answer any questions that you have for just a couple minutes if you guys do have any. Obviously I'll answer them to the best of my knowledge. If there's a particular stock or something I don't follow, I won't have really an opinion on that. But again, appreciate you guys sticking around today, and for all the fathers out there that are viewing in right now, I hope you guys have a great Father's Day. Happy Father's Day this weekend, as well as you play a vital role in a child's life. So happy Father's Day to all the dads out there. So what questions? At the end of the day, Victor says, at the end of the day, they all have the same weight, and I took 25%. Okay, this is into your earlier comment. 25% REITs, 50% stocks, which I'm assuming does not include the REIT stuff, and 25% ETFs. Yeah, I mean that's pretty much in line. I think my ETF exposure is a little bit higher, so it goes back to wanting to build a strong foundation. Depending on how hands-on you want to be, and how much risk, building your strategy out that I kind of talked about. I want to have a good backbone for when things do get shaky in the market. ETFs provide that diversification for me, which is why I always think it's a great idea to have, roughly 50% exposure to ETFs or index funds in that case, especially for newer investors. If you're more seasoned, I can see how that kind of the scales will tip a little bit more if you're in the markets and doing a lot of due diligence all the time and keeping up with the day to day. Then that I can see how you want more individual stock risk. And that's one reason I do the Dividend Investors Edge. Just talking about the free version is it kind of keeps people up to date in an easy to read format. You could see how the market did in the past week, how they've done year to date, what the top 5 stories are, important stories that I want to mention there. What are some analyst upgrades or downgrades in some key notable dividend stocks? I mentioned all that in there. If there's an earnings calendar for the week ahead, stuff to be mindful of where you're not going to 5, 6, 7 different places to get all this information. It's just in one compact information, easy read, probably takes you 5 to 10 minutes max just to kind of scroll through. So definitely sign up for that if you're looking for that weekly information, just to kind of stay on track there. So Mike D is going to always bet on Buffett and BRK. Can't go wrong there. It's been a proven success track record that he has. There's folks that want to bag on him, but I mean, the proof is in the pudding. So, you can't really go against Buffett and his track record. Kath V is going to go with traditional dividend ETFs. I'm in agreement there. I don't own JEPI or JEPQ. I do own, on the other hand, SCHD is one of my largest positions. So, I'm definitely the traditional, which allows me to get more of that compounding nature, which allows me to take advantage of the price appreciation. Whereas when you're selling covered calls and outdated call options, your upside is limited, which is one of the things I don't like about those types of ETFs, speaking of JEPI and JEPQ. Victor says, AI bubble, false alarm or probable outcome? That's a tough one. Due to the run that we've seen, it makes you want to say bubble-like, but we're continuing. Like Adobe just printed earnings today, and again, they're still up. I want to say 5% after hours. When I looked before the start of this live show, up almost 4% right now after hours, after being up roughly 2.5%. So that's about a 7% move, and that's another AI play there. There's still money to be made, investors looking to take advantage of that. Valuations are a little bit high for me, but I definitely think it's something that's real and something to definitely be mindful of. How many times the word AI or the letters AI was mentioned in the earnings call was pretty substantial during the latest earnings results. So awesome. Well, that looks like that concludes our Dividend Power Hour today. Thanks again for tuning in. It's awesome to always interact with many of you. I appreciate all you guys do, all the support. Definitely, if you could hit that like button down below, subscribe to the channel so you're notified anytime we drop new videos and anytime we're going to come on live, so you will be completely notified and not miss it. So again, happy Father's Day. I hope to see you guys next week. Stay safe and stay healthy. We'll see you next time. Take care.